Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian stocks rise as the Sell America trade gains steam amid concerns over the Fed's independence. President Trump announcing new tariffs on countries doing business with Iran, threatening the U.S. trade truce with China, Tehran's biggest customer. Nobel Prize-winning economist Daron Acemoglu joins us with his theory on why Trump does what he does, despite his actions going against democratic norms. And the CEOs of two of India's leading IT firms join us with their assessment of the business environment, as both report profit that fell short of analyst expectations. Asian markets pushing higher for a second day, touching a fresh record high. Despite geopolitical concerns, developments in Venezuela as well as Iran is being brushed off by that rotation from the U.S. to Asia. Taking a look where we are in terms of the benchmarks here in Asia, we have the Hang Seng continue rallying higher, up by more than 1%. Also gains in the TAIEX, which is currently up by 0.5%. And we have breaking news out of Taiwan. A potential U.S. trade deal is pending lawmakers' approval. We have that latest out of Taiwan, probably helping sentiment in the market. Meanwhile, the market rally faces mounting risks. The Fed's rate cut path is in focus, with December inflation data due on Tuesday, and traders seeking a clean read on price momentum. This comes as the likes of PIMCO, PGIM warning that President Trump's challenge to the Fed's independence is introducing a major new risk into markets that could reverse his goal of lower rates. And crude oil is trading near the highest level since early December after Trump threatened to impose a 25% tariff on any countries doing business with Iran. In a social media post, Trump declared the new duty would be effective immediately without providing details on the scope or implementation of the changes. This has the potential to again upend global trade with India, China, and Turkey among Iran's top trading partners. Let's get more insights from the UBS Greater China Conference in Shanghai. Our Chief North Asia correspondent, Stephen Angle, was there with our next guest. Steve.
Yeah, that's right. Hi, Haslinda. Let's bring in our next guest here on day one of the UBS Greater China Conference, held every year for the last 26 years here on the banks of the Huangpu River in Shanghai. It is Daron Acemoglu, is the Nobel laureate in economics, as well as an MIT Institute professor. Sir, good to see you. So,
nice meeting you here, Steve.
You're also the author of very provocatively titled books, Why Nations Fail, co-authors, right? Economic Origins of Dictatorship and Democracy, as well as Power and Progress, which has largely to do with AI. But let's first begin with some of the concepts of why nations fail, and also the economic origins of dictatorship and democracy, given what is happening with the Fed right now. Obviously, a lot of people are saying this is the DOJ subpoena of the Fed and of Jay Powell is another attack on potentially the independence of the Federal Reserve. How do you view this or do you view this as an attack on the independence of the Fed?
Oh, it's an attack into the integrity of institutions. Absolutely. Look, I mean, my research has been about institutions. Why is it that countries succeed or fail? It has a lot to do with institutions. Following rules, what kinds of rules you follow, who has power, how you constrain that power. No system is perfect.
So what happens when power is concentrated too much in the hands of an autocrat? I'm not saying Trump is an autocrat, but autocracy.
I think many people would. Many people would, but I think that's exactly the problem. Institutions are at their weakest when there is concentration of power. And for better or worse, many industrialized nations manage to avoid that concentration of power. What Trump is trying to do right now, what his administration is trying to do right now, is to build an imperial presidency with all powers concentrated in his hands. And the Fed, as well as some of the other agencies, are very important for the functioning of the U.S. economy. They're very important for the health of the U.S. economy. The secret source of U.S. economy has been its institutional success. Its courts, its agencies. That's what's about to collapse right now.
How do you think Trump has been able to sort of upend presidential protocols with his slew of executive orders, bypassing Congress, and other aspects of what a quote-unquote authoritarian leader might employ? How has he been able to do that with those institutions in place to keep the checks and balances in place?
Well, that has so many answers. I mean, one is, unless Congress, if the Congress had not allowed him to do it, he wouldn't be able to do it. So the fact that the Republican-led Congress has essentially given up its responsibility is very important. But in a big picture, you have to understand, U.S. institutions have been in a crisis for quite a while now. And Trump himself is an agent of deepening that crisis, but he's also continuing the response to that crisis. It wasn't just Trump, it was before him Bush, then even worse Obama, and then even worse Biden, who also passed many, many executive orders trying to bypass agencies, Congress, courts, and that's actually already a symptom of something going wrong. But Trump is really trying to destroy the norms that sustain U.S. institutions and weaken all sorts of powers, including some very important like the Fed.
So it's building sort of de facto power as well by placing loyalists in positions where they answer to him.
100%. And when you actually appoint loyalists, especially unqualified loyalists, it is two birds with one stone. First of all, you have people who are beholden to you, but second, you're actually changing the norm. You're weakening the norms that make these agencies work as independent, mission-driven. People are proud to be part of the Fed because it's independent. It's really upholding good, the right sort of monetary policy. You destroy that. Once you destroy that, the entire monetary policy is responsible to you, and you've put your loyalists in there. The same thing with the FBI, the same thing with the Department of Justice. So it's a big erosion of what we have believed in as U.S. institutions.
Will these efforts work over the longer term, or will it backfire?
Well, in many countries they have, but for them to really work, they really need to also destroy electoral processes. So I think Trump is not strong enough to sideline elections in the midterms or in the next general election.
He's floated the idea.
But I don't think he's strong enough. He's getting there, but right now he's not strong enough. So I think voters have to really show that this is not what they want. What happens in the midterms is going to matter a lot. I think at the end of the day, it's the voters, it's the citizens who have to defend democratic institutions. What happened in South Korea is very inspiring. The South Korean president tried to do an accelerated version of the same thing, and voters said no.
Let's, if I can talk to the producer right now, bring up the full screen quote of what Donald Trump told the New York Times in an interview. Essentially, he's saying he's only constrained by his own morality. My mind is the only thing that can stop me. That does not sound like the words of a U.S. president. Is this, regardless of whether Trump succeeds or not, has this changed the dynamic of the U.S. presidency forever?
Well, again, I think you have to see that as a process. It's been going more and more in that direction. But indeed, I think when anybody says they are just constrained by their morality, you know that their morality is not strong enough to constrain them. Because if you really want to be constrained, there are all sorts of institutions. You should strengthen them, not weaken them. Trump has done his best to weaken media, to weaken Congress, to weaken the courts, to weaken bureaucracies. So, no, he's not going to be constrained by his morality.
In your most recent book, Power and Progress, which I can pivot now to some of your thoughts on AI, which also brings into the fold democracy as well, you're fairly critical of how AI is being developed and eventually will be employed, whether there's the anti-worker or the pro-worker. You don't think necessarily that this is at all the way it's going so far good for the worker, and actually has a negative impact on jobs, wages, and democracy.
Absolutely.
How so?
Look, I am not an AI pessimist. I think AI is an amazing technology. It has great promise. But we call it artificial intelligence, and we forget what type of intelligence. if you think of what AI can do, humans cannot do that. Dealing with huge data sets, finding patterns. What humans can do, make quick decisions, quick generalizations, AI cannot do. These are very different things. When you have two different things, the right way is to combine them, to make them complement to each other. You and I are different, we can work together.
Sure.
But what the industry is trying to do is to, under this sort of banner of artificial general intelligence, use AI as an automation technology, replicate what humans do rather than complement what humans do. Automation technologies are not good for workers because they displace workers. They may have other benefits, they may improve productivity, they may then create other jobs, but they're not directly good. But as complementary technologies could create a lot of benefits. But we're not doing that, we're failing at that.
So again, in China, they like to talk about AI as a tool for increasing productivity. But again, to your point, when you go and look at the factories that I've been to, many of them across China, a lot of them are highly, highly automated. There may be one employee, human employee, to multitudes of robots and industrial arms. So what does that tell you about whether there is a bifurcation of the end result of AI? In the US, some say it's greed by the big corporations. China likes to frame it as a tool for productivity. But do you think it's still going to be the end result, and that is anti-worker?
Well, I think there are some differences. I think the most important one is that China is going to have a big labor shortage coming up. So it is a little bit more natural for China to start investing in automation.
Yeah.
And that, the Chinese population is going to halve in the next 50 years or 60 years. That's just enormous. No country has experienced anything like that. The kind of the upheaval that this will create for the labor market is huge. So I think automation has to be part of what China does. And I think automation, I'm not against automation. I think automation is great. We can get rid of some meaningless jobs. But you have to do other things as well. China, until now, has had a lot of faults when it comes to AI as well as authoritarianism. But until recently, China was using AI more like a tool. But the sort of the AGI, artificial general intelligence bug, is now transmitted from the US to China. So China is now playing in this AGI game as well, which I think is a losing proposition at the end.
Now, I don't mean to put you on the spot about your comments about China, but from 3 years ago, or now 4 years ago, in 2022, you wrote an op-ed piece, China's economy is rotting from the head. I think that was the title. You said, as true in all autocracies, no independent experts or domestic media will speak up about the train wreck Xi Jinping, has set in motion. Obviously, China is very confident that it has set itself in the correct direction. Have you changed your thesis on China, or is it still the fact that it's an autocracy with no independent institutions is going to eventually drag it down?
I think eventually it's going to create problems, but there are two things. First of all, China-US comparison, China looks much better now because US is destroying itself. So the China-US comparison,
So by default,
by default is very different than what I would have said 5-6 years ago. Not that I was very confident about the U.S. institutions. There were many problems 5-6 years ago, but they are looking much worse per the conversation you and I had. Second, China has been very good at mobilizing its engineering talent.
Yes.
That engineering talent has carried it very far, but despite those distortions and limitations that a top-down system imposes. So it's a race in some sense. Can Chinese engineering save Chinese AI and Chinese industry?
Yes.
Or ultimately it's going to be subject to the same constraints, it's going to get stuck in some dead end.
Just to pivot back before we wrap up back to the United States, can democracy and the democratic institutions save the moves that are afoot right now to sort of erode that?
Yes, they can, but there's no guarantee. I think the great thing about democracy is that it is a continuous process. It reinvents itself. Look at the US, for example, during the progressive era. Things looked like very, very terrible. It was an oligarchy that controlled politics, wealth was becoming very concentrated, monopolies ruled everything, and then suddenly 10 years later, the US looks completely different. But the bad thing about democracy is that there isn't a recipe for this kind of change. It sometimes can get stuck. And right now I'm worried we're stuck, but this is not time to give up hope.
Professor Acemoglu, thanks so much for your time on Bloomberg Television. Always enjoy getting the thoughts of a Nobel laureate.
Thank you very much.
It's
my pleasure.
Haslinda, going to send it back to you.
Great conversation there. Stephen Angle speaking with Daron Acemoglu, MIT Institute professor and Nobel laureate. Of course, he's saying that President Trump is setting the U.S. on course for a collapse. Coming up, TCS CEO K Krithivasan joins us exclusively to discuss the outlook for India's IT sector after their quarterly profit tumbled 14%, with customers limiting spending. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Tata Consultancy Services reported third-quarter earnings that missed analyst estimates as clients limited spending on IT projects. Asia's biggest outsourcer posted a 14% slump in net income on a 5% sales increase. Profit was also hurt by expenses tied to layoffs, the impact of new Indian labor codes, and provisions for a legal battle in the U.S. Well, joining us exclusively, K. Krithivasan, MD and CEO of Tata Consultancy Services. Mr. Krithivasan, good to have you with us. Are we looking at potentially better quarters ahead? What are your own assumptions?
See, if you look at what we have gone through in the last couple of quarters, like when we Q2, we did mention about the improving demand scenario. And we see that for us, Q2 is the quarter ending September. And the current quarter ending December, we continue to see those trends of improving demands. And so that gives us optimism that going forward into the CY 2026, the overall demand situation should be good. And we also see our clients increasing their spend in AI. Previously, there was a lot of hesitation, or they were waiting and watching on seeing what is the best way to invest. But now we find increasingly clients are looking at the ROI, where the ROI is better or the payback period is shorter. Those projects are also getting approved. And so at least in some pockets, the decision-making cycles are improving. So all these put together, we are more optimistic for the quarters to come.
So more optimistic, what does that necessarily mean for your margins? We know there are pricing pressures, and we know that companies are increasing their investment in AI, in cloud. That impinge on margin.
Not necessarily, Haslinda. TCS has been working at a margin one of the highest in the industry. And we always set our goal to be playing somewhere between 26 and 28% EBIT. And given what we see today, and given what we have gone through in the last couple of quarters, we also went through where we restructuring exercise we did. All of that put together, we should be currently we are at EBIT of 25.2 post the one-offs. So excluding the one-offs, we achieved 25.2 in line with what we did previous quarters. And we are quite comfortable in maintaining this level. In fact, as I said, we would target to be in the 26 to 28% range in EBIT.
The focus is when AI will, I guess, add to revenue materially. Right now, the focus is on, programs to move from pilot to perhaps revenue contribution. When will that happen? When are you expecting that to happen?
So, in this quarter, we announced because there could be always a tendency to do some AI washing. So internally, we decided that what we are going to call AI revenue, what we will not call. And we also decided to publish those numbers. So this quarter, we announced that our annualized revenue of AI is about 1.8 billion. And it has shown an increase since the previous quarters also. It's roughly almost a 20% increase quarter on quarter on our AI revenue. So if you ask me, it has started improving on a quarterly basis. But is it also compensating for the deflation or the overall challenges we have in the macro and economic scenario? Not yet. But our guess is within a year, you would see AI revenue becoming really material.
You've made some small acquisitions. Are there plans to make further acquisitions to boost perhaps your AI capabilities?
So we announced acquisition of Listing Gauge. It's a small Salesforce consulting organization. And in this quarter, we are also completing the acquisition of this company called Coastal, which is focused on Salesforce consulting, particularly in the marketing and sales cloud. And together, it places TCS in the top 5 of the Salesforce consulting overall league table. And similarly, we are looking at opportunities where we will be able to attain some capability and competencies at speed and scale. So we have changed our position towards M&A. Now we are declared to the market will be more acquisitive going forward. And we are looking at a number of opportunities where we can improve our competency either in a technology or in a business domain.
So that might happen in the next, 6 to 12 months?
We are not putting a timeline on what we would do. We are looking at a number of opportunities, and some may happen soon, some may happen later. But we are not, as I said, it is more for acquiring certain competencies at scale and speed. So whenever we see opportunity, we will move fast. But we are not putting a timeline on ourselves.
You said earlier that certain pockets of the tech sector is spending, recovery is coming, but could you give clarity on which sectors, which segments are actually, embarking on the spending plans and which are showing some restraint?
Haslinda, if you look at compared to previous quarters, what we saw in the last 2 quarters, there has been a general uptick. Even the telecom sector for us, which was quite sluggish. In the last 2 quarters, even telecom has started recovering. And the challenges we had in the last quarter, or there is a quarter that ended in December, are primarily because of the seasonality. There is some of the regions, particularly in Europe, UK, and Asia Pacific, they go on a furlough. And we have a bigger impact in the banking, financial services, and tech services sector because of that. But if you exclude the seasonality and the furlough, you would see that there's been a general pickup in almost all the industry verticals. There could be some pockets. If you take airlines, domestic airlines, we have some softness, but otherwise it's been quite strong across the consumer segment. So at this time, we see that there's a general pickup across the board. Particularly, customers are looking at both cost takeout projects and short ROI projects. Yeah.
Very quickly, Mr. Krithivasan, how are you thinking about hiring and the impact from the H-1B visa?
See, the way we have been looking at is our dependence on H-1 in the last few years has significantly come down. Of the overall workforce we have in US, less than 50% are visa dependent. And we continue to hire more and more locally. And the number of people we send from India to US for H1 is limited. Wherever the clients want the particular individuals for the continuity or for the knowledge they have on the UN program, only then we send people from India. Otherwise, we hire locally more.
Mr. Krithivasan, we thank you so much for your time there. K. Krithivasan, MD and CEO at Tata Consultancy Services. More on India's IT sector coming up. We'll be speaking with HCLTECH CEO. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight, and here's a quick look at where markets stand as mainland Chinese markets head to lunch and Japan comes back from break. Here's how it's looking for Asian benchmarks. They're touching new record highs on the back of that rotation from the US to Asia. That's a result of geopolitical developments, both in Venezuela, in Iran, and of course, the pressure that the US government is putting on the Fed. The MSCI Asia-Pac index continues to grind upwards, up by 1% right now. We're seeing gains in the Hang Seng currently up about 0.9% gains too for the likes of the Nikkei and the SET. And we're tracking the start of trading for the Indian rupee after the latest inflation reading for India once again came in below the RBI's target range, leaving the door open for rate cuts. For more, let's bring in Bloomberg economy reporter Krithivasan. Shruti, what do the latest CPI numbers really signal here?
So as you mentioned, Haslinda, the December print, which came yesterday, it showed that the inflation remains firmly below, RBI's target band of 2 to 6%. It stood at 1.33% in December, and this is the highest in 3 months. This clearly shows that RBI has room for further easing. In the last year, RBI cut rates by 125 basis points in total, but still, it shows that but still we see the signs of the transmission of rates not happening in the market, in the banking system, and we also see that yields remain high. So this CPI number clearly shows that RBI can use the opportunity in the next meeting, which is in February next month, to see if it can cut interest rates further.
The only problem is that India has a very weak currency. Its lackluster performance versus its Asian peers has caught a lot of investors' attention. How might that deter the RBI's move?
So there are a couple of things which will determine how RBI moves in its next policy meeting. The first, it's concerns about growth. While India, is expected to grow by 7.4% in the year that ends in March, there are headwinds in terms of Trump's tariffs. India is yet to sign a trade deal with the US, and it's still saddled with a 50% punitive tariff. So that is, of course, going to be one primary concern. The other thing is that India is going to revise the base year for its GDP next month. So would RBI want to take that chance and cut rate before the base year revision is done or not is something else that is to be seen. The third thing that economists are saying is that the transmission has not happened transmission has not happened in the last year despite a rate cut of 125 basis points. So RBI may want to focus on in enhancing liquidity in the market instead of cutting rates. So there are a couple of points, which RBI would factor in before it takes a call on interest rate cuts in its next policy meet.
Shruti, thank you so much for that. Bloomberg Economy, Trade and Investigating Agencies reporter Shruti Srivastava. And we'll be watching Indian IT names at the India Market Open as the nation's big tech firms kick off earnings season. HCLTECH joining TCS with a profit miss, posting an 11% slide in third quarter net income. It's also narrowing its sales forecast for the full year, now forecasting growth in a range of 4 to 4.5%, compared with a prior estimate of 3 to 5%. Let's get perspective with C Vijayakumar, MD and CEO at HCLTECH. Mr. Vijayakumar, that lackluster performance, how do you turn it around?
Actually, we've had a fantastic quarter. I don't think you got the numbers right. The margin difference was due to a one-time cost due to the labor code impact. Otherwise, we've had a very, very strong quarter, 4.2% sequential growth. Our margins expanded. We had exceptional bookings. And we've also increased our revenue guidance, both on the services and the total company guidance.
So in terms of how you accelerate the business from here, what would be the strategy over the next 12 months?
I think right now, we believe we've had a strong booking. We had a $3 billion booking, which was almost a 45% increase year on year and a 17% increase on a quarter on quarter. And we see a good pipeline, and we will continue to win more. And our wins are all based on the investments that we've made in AI, building certain IPs, which really make all the LLMs and the intelligence layer much more scalable and applicable within an enterprise context. So we signed a mega deal with a global retailer, which is close to $500 million. This is really transforming all their application landscape using AI as the primary lever, using our AI Force 2.0 agentic platform, and really changing the operating model to really benefit significantly from AI. So we believe there will be more such opportunities across our coverage universe to go after in this year.
In terms of those mega deals, are you anticipating more in the next 12, 24 months? Are you in conversations?
Yes, of course. Mega deals are not very predictable. Sometimes you might have it in a quarter, it might not be there in the next quarter. But if you take the next 12 to 24 months, we definitely expect a few of them.
How about your AI partnerships with the likes of hyperscalers? What are you anticipating?
We've had very strong partnerships with all the hyperscalers. We are one of the first service providers, global system integrators to become a partner with OpenAI. We've had a very strong relationship with NVIDIA. In fact, we were mentioned in the NVIDIA keynote in CES just last week as one of the leading partners in robotics and physical AI. So I think creating these partnerships and creating solutions around these technologies is going to be a very important success criteria for us to scale our AI business.
These are such challenging times, especially geopolitically. What macro environment, what client behaviors might push your guidance to the lower end of what you have revealed to the market?
We have only one quarter to go, so we believe we will deliver within the guidance midpoint or even better than that. That's really what we are expecting. But we always factor in a pessimistic scenario or an optimistic scenario, so you don't know what is in store. There's a lot of volatility across multiple areas across the world, so that's why we factor in a pessimistic and optimistic. Pessimistic at the lower end and optimistic at the higher end.
And given the optimism, how's that shaping your thinking on hiring plans? Are you adapting? And where exactly are you hoping to perhaps, focus your headcount? Could that be AI? Could that be cloud? Could that be cybersecurity?
All of that, whatever you mentioned, cloud, cybersecurity, data, AI, all of these are areas of focus for continuing to add talent. Over the last 12 months, we've added about 6,000 people. Our revenue growth is still higher than our people count growth. That is a trend we are going to see for some time because there is AI-led productivity, amplification of human potential using AI. All of that will translate into higher and higher revenue per employee as we grow our business model. We will see some amount of non-linearity kicking in as well.
So is there a number you can share with us in terms of the headcount that you're looking at?
We've not called out any specific headcount additions. It's very dependent on every quarter we plan, and we also have a lot of internal talent whom we upskill and deploy them on new projects. We have a good fresher pipeline. Our fresher talent almost increased 40% year on year from 24 to 25. So we have multiple fulfillment channels which will drive our overall fulfillment strategy.
Are hiring plans contingent on the H-1B visa regime? Are you looking at nearshoring, onshoring of talent as a result of what the U.S. is doing in terms of H-1B visas?
Over a long period of time, we've really reduced our H-1B dependence to almost negligible numbers. So I don't think it has any specific change in strategy. We will have continue to have a lot of local hiring in different geographies, including the U.S. And there are certain nearshore centers which we use for certain specific services and time zone perspective, which will continue to scale as we grow our business.
Of course, we're keeping tracks on geopolitical developments. Do you see that as a risk to your business, given that clients may be reluctant to spend as a result of the uncertainties?
Yes, of course. Geopolitics is a risk in for every business in every corner of the world today, and we are no exception. I think definitely that's something we have to constantly watch out, but at the same time we have to look ahead and see how you can add value to our clients, and that's where our business momentum continues to be strong.
So how much clarity then are you seeing from your customers, from your clients, in terms of the spending? Because that is a reflection of the confidence they have in their business.
Yeah, I think 2026 budgets and visibility, all of that is still early days. We don't have great visibility across a number of customers. But we think the tech spend is going to be a very important component that will help clients to really transform their businesses. So I do believe tech spend will continue to increase because it's so pivotal for every large enterprise's sustenance, transformation, growth, all of that. So I think that's where the confidence comes from. Fundamentally, there's going to be a lot more tech spend. Sometimes it is on hardware, software, but all of that very quickly translates to some services to make these technologies work for our clients. So go ahead.
Right, talk to us about that tech spend. What are you seeing? Who's spending more on the investments in technology right now?
I think the biggest spender is the technology companies, the top 10 companies who are hyperscalers and some of the top compute and semiconductor firms. That's where the largest spends are happening. And we are really helping them in various areas, which is translating to good services revenue streams for us.
For a company with a global footprint, how are you assessing the weakness of the Indian rupee and what impact is that having on your business?
Yes, of course, it does help a little bit on the margins because a significant part of our cost base is in India. So I think it does help our business to be more competitive.
Why do you think the Indian rupee is so weak when growth is in excess of 7% among the fastest growing economies in the world?
I don't have a ready answer for that. Maybe you should ask an economist.
I'm just wondering how businesses look at the weakness of the currency. Do you have views on the upcoming budget? What are you hoping to see? How do you think tech companies in India can benefit from it?
Yeah, I think overall the government of India has been extremely supportive of growing businesses, especially export-oriented businesses, as well as a lot of domestic business models are significantly transforming. I'm sure they will continue to have a very positive and supporting kind of policies as we see through the budget this year.
But what policies and what incentives might help tech companies like HCLTECH?
We're not specifically looking for any specific incentives, but of course the biggest ingredient in our business is the talent, and anything the government can do to help get better talent out of the colleges who can be readily deployed into the workforce is what will greatly help. And I know that's one of the very big focus areas for the government as well.
And one of the concerns for India as a whole is the lack of deal between the U.S. and India on trade. How concerned are you that India has struggled to secure a trade deal with the U.S. and the implications on the Indian economy as well as businesses?
Yeah, like everybody, I also expect we do expect and we hope this gets resolved. Beyond that, I know only as much as what you can read in the media and all of that.
Mr. Vijayakumar, thank you so much for that. C. Vijayakumar, MD and CEO at HCLTECH. We'll have more on India's earnings season. The CFO of IT services and consulting giant Wipro will be joining us for an exclusive interview next Monday. Now let's do a check on how Indian markets are doing as we count down to the open. Of course, we have Asian stocks notching yet another record high, boosted by that rotation from the U.S. to Asia. The the Sensex also pointing to a higher open as we count down to that open session. India has been a laggard versus the other Asian plays on the back of concerns over the trade deal and the weakening rupee, which is struggling to regain strength versus the USD. In terms of what we're seeing in terms of the Indian rupee right now, trading at 90.24, it is currently flat versus the USD. Of course, we've had conversations on the show that that trade deal may be coming soon, but we have been waiting for about 5 months now. Still to come, the latest from the India visit of German Chancellor Friedrich Merz and his call for stronger economic and security ties to counter global instability. Keep it here with us. This is Bloomberg.
Growing trade and investment ties has given new energy to our strategic partnership. Our bilateral trade has reached its highest level ever. The growing cooperation in defense and security is a symbol of our mutual trust and shared vision. I express my heartfelt gratitude to Chancellor Merz for simplifying the priorities related to defense and trade. We will work on a roadmap to increase cooperation between defense industries, which will open up new opportunities for co-development and co-production.
Indian Prime Minister Narendra Modi speaking about growing ties in business and defense with Germany as Chancellor Friedrich Merz continues his 2-day trip to India today. Let's get more on the bilateral talks with our India government reporter Sudhi Ranjan Sen in New Delhi. Sudhi, what were the key messages from Merz as well as from Modi?
Well, the key message that comes out, after the bilateral meeting was one that India and Germany both are looking at each other, as very trusted allies, trusted partners, and that partnership now, spans not only just business or commerce, but very critical areas such as critical minerals, defense, co-production, jointly developing equipment, and Chancellor Merz in his address said that it's good for both countries and allows India to reduce its dependence from Russia. That has been one of the key messages that Chancellor Merz carried reiterated and stressed. The other key thing that came out was Germany is also pushing that the India-EU trade deal kind of gets across the line, which has been under negotiation for long, but now seems to be nearing the end of it. And we could, see a formal announcement in a couple of weeks. In fact, as early as the next week.
So power politics shaping the conversations in India. We also heard from the new U.S. ambassador to India, Sergio Gore, who spoke on his first day in office. Here's what he had to say.
We are raising the standard for diplomacy itself. That means fair trade, mutual respect, and shared security. Many of you have asked me for an update on the ongoing trade deal negotiations. Both sides continue to actively engage.
Gore also invited India to join Trump's Pax Silica alliance aimed at securing chip supply chains. Have a listen.
Pax Silica is a U.S.-led strategic initiative to build a secure, prosperous, and innovation-driven silicon supply chain, from critical minerals and energy inputs to advanced manufacturing, semiconductors, AI development, and logistics. Nations that joined last month include Japan, South Korea, the United Kingdom, and Israel. Today, I'm pleased to announce that India will be invited to join this group of nations as a full member next month.
Sudhi, what do we make of that invitation amid, I guess, the lack of deal between the U.S. and India on trade?
Well, I mean, the trade deal is the main thing, and trade deal, if that works out, would be a great boost to the India-US relationship, which seems to be, is going through a very difficult time. But that said, there are other issues like the defense cooperation, the security cooperation, and cooperation in other areas are going forward. So while there is this big disappointment in the relationship, there are other areas which are still functioning and still going forward. So, I mean, the fact that the US has invited India to join Pax Silica, which is about critical minerals, which is about semiconductors, is a good development, but much more needs to be done to bring the relationship back on track.
It is still, in the end, about that trade deal, and we heard from a U.S. envoy saying that all the differences will be resolved. We have been here before. We have heard this before. The question is when and where are we with that?
Well, that's a very, very difficult question to answer. I mean, the Ministry of External Affairs, in fact, last week said in response to Secretary Luttig that, we've been close to the trade deal, but something seems, things haven't worked out. The only conclusion one can draw is while the economics part of it would have been worked out on pen and paper, the political part of the deal, as in a win-win for both leaders on both sides. There is still some distance to go before both sides say it's a win for both of us. So that is where it appears is stuck.
Sudi, we continue waiting. India government reporter Sudi Rajan Sen on the latest in India. India's been trading for about 10 minutes now. Let's do a check on those tech names. Amid the tech earnings season, we have the Sensex currently being lifted by 0.2%, gains too for the broader Indian benchmarks. In terms of the tech plays, let's do a check on how Tata Consultancy Services is doing. It did miss analyst estimates due to limited spending on infotech projects and one-time costs. We know that TCS reported a 14% drop in net income, a 5% rise in sales, with expenses related to layoffs and provisions for a legal battle also hurting products. Tata Consultancy down 0.3%. HCLTECH, though it is trading higher despite missing estimates as well. We know that IT services exporters like Infosys are waiting for tech spending to recover. They're also bracing for disruptions to do with AI. And this is how it's looking for Asian benchmarks. They are in positive territory, touching yet another record high. The MSCI Asia-Pac Index currently up about 0.9%. We're seeing capital flowing from the West, the U.S. specifically, to Asia. Lots of geopolitical concerns as well as concerns of Trump's pressure on the Fed. Coming up in our next hour, we'll talk markets with Cambridge Associates Asia head Aaron Costello, who sees only limited upside for global growth this year. And we'll discuss the implications of potential U.S. intervention in Iran with Quincy Institute Executive Vice President Trita Parsi. More to come. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Let's do a check on Asian markets. The MSCI Asia-Pac Index touching a fresh record high. Asia pretty much shrugging off geopolitical concerns. The focus is on earnings, regional economic growth. We've seen how investors are broadening their focus beyond U.S. markets, rotating capital out of the U.S. towards Asia. MSCI Asia-Pac Index up 0.9%. An outperformer right now would be the Nikkei 225. It is up more than 3%. The Kospi higher by 0.7%. Of course, the Kospi has been a rock star, adding to gains, which we saw in 2025. Let's bring in Bloomberg's managing editor for Asia equities, Len Ting Tu, for more on the market action. It does seem like, of course, that rotation from the U.S. to Asia continuing.
Yeah, it is continuing. But if you look at U.S. stocks, they are also at a record high. So, as you said, people are shrugging off a lot of geopolitical tensions right now, including the Venezuela tensions. tensions, Iran tensions, and this morning, Trump's new tariff threat of 25% on countries doing business with Iran. And earnings will really be the focus right now for global investors. If you look across the board, they all look rosy. We start from S&P 500. The expectations is for the strongest earnings guidance since 2021. That's some good size and scope for you. And if you look at China, 15% expectation of earnings growth for the next 12 months, even better than Japan. And we haven't even talked about Korea, 70-something% growth expected for this year.
How quickly China went from uninvestable to exceptional? What would it take for those gains to be sustained?
Yeah, I mean, I think earnings is really the main thing, right? Last year, we saw the re-rating of Chinese stocks in terms of valuation expansion going from 9 times to 12 times earning PE for MSCI China Index. And this year, Goldman Sachs and a few other buy-side investors have been talking about how the gain will really almost entirely be driven by earnings. And if you look at this morning, UBS CEO sounding really a bullish tone on China, talking about how the technological innovations are going to keep getting global investors to look at China again. And today we're seeing technology shares in China gaining quite robustly, including Alibaba up more than 3% after a 5% gain last year. So yeah, there's a lot of fronts, not just AI, but also commercial rocket space in China that is heating up, in addition to robotics. So there's just a few bright spots, I should say, that people are looking at.
We've been talking about how India has missed out on the AI rally, and we've seen, well, some relief today, but that's on the back of 6 days of losses, and some are saying that those losses will persist throughout the year.
Yeah, that's very likely. I mean, India really doesn't have any AI names. I know some IPOs in the pipeline are looking at some AI adjacent companies, but not quite there. But in India, people are actually looking at the ECM, the IPO space, just because that is actually a bright spot. We talked about how overall IPOs are not quite performing in India, but if you look at the bigger ones, the ones that are above $300 million fundraise, they're actually performing quite well. We're looking at more than 10%, 15% gains last year. So a lot of funds, including local funds and global funds, are actually just looking at the IPO space in India.
You know, it's interesting. As much as we talk about how investors are shrugging off geopolitical concerns, they're also taking cover. Gold is the case in point.
Gold and silver, just unstoppable. Any negative news on the geopolitical front, people just go to gold. Again, gold has a cyclical, or I should say secular tailwind, which is central bank buying. And we have been reporting that they are not really looking at prices. They just want to keep getting that reserve. And the one big reason is the de-dollarization. As you said, the whole Fed investigation is just to bring in that concern about U.S. investability and Fed independence fresh on top of people's mind.
Who would have thought people would question U.S. investability? Tianting, thank you so much for that. Bloomberg's managing editor for Asia Equities, Lianting Tu. Well, our next guest believes elevated stock valuations, concentration in a handful of stocks, and mediocre macroeconomic conditions have heightened equity market risks. Let's bring in Aaron Costello, Asia head at Cambridge Associates, with managers over $600 billion in assets. Aaron, good to have you with us. Never mind the risks, it's buy, and we're seeing that today.
I mean, exactly, and I think that's why we're getting more and more nervous. Data came out, I think, last week showing that U.S. households now have a record equity exposure. Our internal data also shows that our clients have record levels of equity exposure. And so that's why our theme for this year is finding value amid the hype. And we're actually advocating investors to rebalance and diversify portfolios and kind of take some of this equity risk off the table a bit.
Are traders too upbeat, too sanguine about prospects? And, are they wrong in underpricing, shrugging off geopolitical tensions, a world where Trump is pretty much upending the world order?
I mean, the market relationship with geopolitical tensions has always been one of ignore it till it hits, sell off sharply, and then rebound. We saw that last year, even with the 12-day war between Israel and Iran. Markets sold off very briefly and recovered, and that's always been the pattern. I think the real thing is the geopolitics, can impact in the short term, particularly given how stretched markets are. The bigger question here really is kind of the health of the U.S. economy, the health of the U.S. consumer, and the U.S. labor market. And right now, the market is very kind of blasé about that, and that's the one kind of big risk for the year that can upset the Goldilocks outlook. And so I think that's where looking at the earnings of companies, looking at the fundamentals is going to be more important than the geopolitics over the rest of the year, albeit in the short term, if things become more unstable in Iran, that can also trigger a sell-off in markets.
So markets getting used to geopolitical concerns, geopolitical risk, but they're not liking what the Fed is doing, the pressure that Trump is putting on the Fed, that is prompting sell America.
Yeah, I think, look, if the Trump administration wants lower interest rates, what they're doing with the Fed is arguably counterproductive here. And I think the market action yesterday kind of summarized that. Equity markets initially sold off, but more importantly, bond yields went up as the bond market has to price in this risk premium of government interference. And so I think from our perspective, that's part of our kind of underweight the dollar theme. The U.S. dollar valuations are very expensive, over 30% expensive on our metrics. Non-U.S. markets are more attractive, less concentrated in AI. And so I think by positioning that way, you're kind of diversifying your risk and at the same time, insulating portfolios from what could be a messy situation should the U.S. bond markets begin to price in Fed interference. Although our base case that the Fed interference won't actually occur, you had pretty strong signals from the Senate yesterday that they're not going to kind of tolerate this, and that I think actually allowed U.S. equity markets to recover from their initial sell-off yesterday.
How about the theme? How might that play into de-dollarization or not?
Look, I think de-dollarization is a catchy phrase and maybe overused. I think fundamentally the dollar is overvalued, and this has happened 3 or 4 times in the past 60 to 70 years. And so again, if the Fed starts cutting rates, if investors start to move away from the overconcentration AI theme, they kind of see the value in non-U.S. markets, the dollar will weaken. And if that coincides with rising interest rates in the U.S. due to kind of geopolitical premiums or kind of concerns over Fed interference, so be it. But the fundamental thing is that U.S. assets are expensive, non-U.S. assets are less expensive. And again, that there's a rotation going on in markets that is natural. And we saw the same thing happen back in the 2000s during the previous tech bubble. At some point, the U.S. market just got too expensive, too concentrated, and capital flowed elsewhere. I think it's as simple as that.
Given concerns in the U.S. right now and over policies that Trump is adopting, do the treasuries look less attractive as a haven play, you think?
This question comes up quite often. We're neutral on duration, and we're kind of neutral on government bonds here. I think right now, in the absence of a growth scare, yes, people factor in these risk premiums, and they seem "quote unquote" less attractive. But if the U.S. economy rolls over, because the labor market rolls over, and the Fed starts cutting rates aggressively, Treasury yields will rally. And so I think Treasury yields still provide some defense in portfolios. Having global bonds still makes sense having portfolios. And so again, we don't want to get too negative on fixed income, particularly government bonds, right when, because they still have the ability to rally amid a true growth scare. I think we're more concerned about public credit because, again, spreads there are also almost back to record lows, not much defense in the credit space. And so for us, actually, given the overvaluation in equities and credit markets, we actually think hedge funds is an interesting place for investors to consider reallocating to this year, particularly like kind of lower beta hedge funds that are uncorrelated, have the opportunity for kind of manager outperformance. And again, because the equity and credit markets are so expensive, allocating to this segment helps diversify portfolios and generate returns without being over-reliant on equity markets going up and credit spreads remaining tight.
Aaron, we continue to see the themes and trends that we saw in 2025 play out in 2026. How should your portfolio look like this year? Would it be the same or different from what you adopted last year?
Well, I guess fortunate for us, last year we were also in the theme of overweight non-U.S., underweight the dollar, and overweight small caps. And so while that may not have played out in the first quarter of the year, it played out for the rest of the year, and we're still sticking with that positioning. We think, non-U.S. markets are more attractive. We think small cap stocks are more attractive. And again, given the over-concentration in the U.S. tech stocks, having a more diversified portfolio makes sense this year, and that's what we're sticking with.
And if you take a longer-term perspective, 5-10 years down the road, because there are lots of long-term investors here, which asset classes, how should you be looking at mobilizing your capital right now?
Well, I think, taking a long-term view, you always have to be invested and have, exposure to equities and bonds and all the asset classes. I think for us, it's really about thoughtfully playing the AI theme. And so right now, the AI theme has kind of been concentrated in these handful of large U.S. tech stocks and some of the plays in Korea and Taiwan as well. And the reality is, if AI is really going to become a successful, impact on the global economy, that's going to spread further. And so what you actually want to position the portfolio for are companies that are going to harness AI to improve their business models or disrupt existing industries. And so almost by definition, if AI becomes successful, the gains need to broaden away from the handful of stocks now that are doing call it the AI infrastructure build out to the broader economy. And some of these companies are actually best played by private markets, whether it's private equity growth, venture capital. Some of these future winners are going to be found there. We also think an important theme that investors need to look at is actually energy grid modernization and energy efficiency. Because to fund all of this AI, you need improvements in the grid and energy efficiency, but also just in general, adoption of electric vehicles, et cetera, energy grid needs to be upgraded, and energy plays are more interesting from a longer term perspective.
Aaron, stay with us. Aaron Costello, Cambridge Associates, is sticking around. When we come back, a look at why Chinese regulators are said to be scrutinizing how Jane Street Group and other foreign firms participate in its $859 billion ETF market. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Bloomberg has learned that China is scrutinizing how Jane Street and other foreign firms participate in its $859 billion ETF market. Sources say Chinese regulators are keen to understand trading patterns in the fast-growing industry. Let's bring in India equities option reporter Savio Shetty. Savio, what exactly are Chinese regulators looking into when it comes to Jane Street and other foreign ETF market makers?
Hi, Haslinda. Good morning. So Chinese regulators are essentially examining how Jane Street and other big HFT players are trading in the pretty huge Chinese exchange traded funds market. That's almost a $900 billion market. It's not an investigation of sort. There's no accusations of any wrongdoing. They're just looking at trading patterns and how things are going. This obviously follows what happened with Jane Street in India. And I think the regulator just wants to see what's happening in the exchange traded fund market in China.
We know that Jane Street is scaling back in India, expanding elsewhere in Asia. What does this shift tell us about how global trading firms are navigating all the regulation risks?
So Jane Street has pretty much stopped its trading in India after the order, and we have the next hearing on January 19th. As of now, associates tell us that they are trading in exchange-traded funds, in interest rates, in U.S. Treasuries. But I think that's how it goes. When one market doesn't seem to work in their favor, they tend to go to other markets. So I think it's pretty par for course in that sense.
And do you see any broader implications for foreign participation in the Chinese market?
So as of now, things seem to be pretty okay. We've had UBS pause some trades for Jane Street. Jane Street tells us that it's business as usual. So as of now, there doesn't seem to be a broader crackdown as of sort. It's just that the regulator just wants to examine some trading patterns and see where this goes, especially with how retail dominated some of Chinese markets are.
Savio, thank you. Bloomberg India equities option reporter Savio Shetty there. Let's get to Aaron Costello, head of Asia at Cambridge Associates, is still with us. Aaron, what do you make of China's move? Is there any reason to be concerned? When it comes to regulation, foreign investors are pretty sensitive to China's moves.
I mean, look, they are rightfully sensitive, but this just sounds like regulators doing their job. And so there's no concern from my perspective. And Bloomberg is leading the scoop here, so we'll take cues from you guys.
Aaron, we have something to mark here. The yen currently falling to 158.88 per dollar. That is the weakest level since July 2024. Of course, we've seen that weakness in the yen. It fell on speculation that a snap election would be happening in Japan. Just to get your thoughts on it, on the weakening of the yen, we have Takaichi, the prime minister, now intending to call snap elections, and that's according to Kyoto. To the point that I was just making there, what do you make of the yen movements right now?
Yeah, I mean, the market is responding to the election news because the assumption is that the LDP is going to win potentially more seats and more control in the Diet, and so therefore expectations of further fiscal stimulus, and therefore perhaps a BOJ that's going to not hike rates as much. I think really that's the issue facing Japan now is the weak yen is causing some inflation in Japan, and there's an affordability crisis, and so the BOJ is reluctant to hike rates, and that's caused the yen to weaken or to continue to weaken. And now again, the Japanese are kind of stuck here because once the yen starts approaching 160, the government ministers start threatening to intervene because they don't want it to fall too much because of that inflationary pressure that a weak yen provides. But the real way to provide stability to the yen is to actually increase the interest rates. So it's sort of a catch-22 for the Japanese yen at the moment, and we'll see how the election plays out. But the assumption here is that at least the market action is assuming that the snap elections will be in the prime minister's favor, and therefore increased fiscal stimulus is coming to Japan. And that's also why the equities are up 3% today.
I just want to recap the headlines that we have right now. According to Kyoto News Agency, Prime Minister Takaichi conveying her intention to dissolve the House of Representatives. She intends to call for a snap election, and hence we're seeing that movement in the yen. We talk about possible intervention. How likely is that intervention, especially when you take a look at how the JGBs are moving right now?
I mean, look, over the past few years, whenever the yen gets close to 160, they have either verbally intervened, as I think they were even trying to do over the weekend, talking to the U.S. Treasury Secretary Bessent, and or they have been known to intervene directly. And so again, if the movements continue to be large in one direction, the Japanese will probably intervene. How successful it'll be remains to be seen, because again, fundamentally, especially if the Fed is on hold for the intermediate period, the BOJ needs to hike rates, or at least the BOJ needs to sound hawkish to put the floor under the yen in the near term.
How attractive are Japanese assets? How would you position in Japan?
So we like Japanese assets. We think over the longer term, the weak yen will begin to appreciate. So investors will have a tailwind at some point from yen strength. I think the interesting thing about Japan is this kind of corporate governance theme that continues to play out. And we think that's best actually played through private investments in Japan. Japanese buyouts are investing in, with managers pursuing the kind of activist shareholder value theme. Japanese small caps is another way to play that theme, because as the M&A continues to increase, they tend to benefit from that. I think where we're less interested in Japan is in the large cap stocks, because the large cap stocks in the index are tied inversely to the yen. So yeah, yen weakness, the large cap stocks go up, yen strength, they go down. The real story in Japan is this corporate governance kind of theme that's going on, and that's best played through buyouts or more niche strategies directly targeting that.
Aaron, I want to pick up a conversation on China. We know that China is showing exceptionalism, reversing the uninvestable theme that we saw a good part of last year. I'm just wondering, where do you see opportunities in this market, which has been driven by AI plays?
Yeah, I mean, I think we largely agree with what your colleague said earlier, that again, the key to the sustainability of the Chinese equity rally is earnings growth. The earnings growth has to deliver. And key to that is actually deflationary pressures in China easing. And so until there's more confidence or confirmation that the deflationary pressures are easing and earnings are going to rise, there could be some headwinds for Chinese equities in the short term, because ultimately they need the earnings to pick up. We never thought that China was uninvestable. We know that investors have some skepticism there. One area to, again, continue to look at is actually China healthcare. That's also been on a tear. There's been lots of IPOs and activity in the China healthcare space. We actually think that's quite interesting. And China VC, again, lots of concern about investability given U.S. kind of regulations there, but a lot of innovation is going on in China, and it's a less crowded space. Foreign investors have walked away, and so those with the appetite to dive back in, or at least put a toe back into Chinese venture capital investments, are probably going to be rewarded given what's going on there and the fact that valuations have come down, and it's a lot less crowded space at the moment.
Interesting to see that CPI has improved. Just the CPI data out today showing improvement in China's inflation story. People talk about reflation in China having an impact on the world, including, the treasuries in the U.S. What's your take on how this might play out?
I think the uptick in Chinese CPI is modest at best and may be reflecting commodity prices at this stage. We need to see really the Chinese GDP deflator go from negative to positive to see that there's really economy-wide inflation in China. I think the more important thing is actually the action in the renminbi. So renminbi has been strengthening. It's broken through 7. It's starting to strengthen on a trade-weighted basis. It does now seem that the Chinese authorities feel the economy is strong enough to deal with a strengthening renminbi. It may also suggest that the Chinese authorities really are moving away from the reliance on trade. I think for the past year or so, they've really been focused on trade as a driver of the economy and wanting to keep the RMB steady. Now that it's appreciating, it may be signaling that they are focusing more to domestic consumption, and that would be a big game change for China, and that's something that we need to monitor quite carefully, closely. But again, I think a strengthening renminbi is generally a sign of Chinese policymakers having confidence in the economy.
Aaron, thank you so much for your time today. Aaron Costello of Cambridge Associates. Let's recap the headlines we saw moments away. We have the Japanese yen weakening as much as 0.5% on the back of Japanese Prime Minister Takaichi intending to call a snap election, and that's according to Kyodo News Agency. Takaichi telling the ruling party official of her intent of that election, the yen again falling to 158.88 per level. That is the weakest level since July 2024. Still to come, Iran says its security forces have regained full control after 2 weeks of violent unrest. The Quincy Institute will be breaking down the issues gripping the Middle Eastern nation. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Crude oil is trading near the highest level since early December after Trump threatened to impose a 20% tariff on any country doing business with Iran. In a social media post, Trump declared the new duty would be effective immediately without providing details on the scope or implementation of the charges. This has the potential to again upend global trade with India, China, and Turkey among Iran's top trading partners. For more, let's go to Dubai and bring in Horizon's Middle East and Africa anchor Jumana Basachi. Ju, this is a fast-developing story. What's the latest here? We know that Iran said it has quelled the protests.
Well, it's saying that, but of course, the information is thin on the ground. We know that they have imposed an internet blackout over the last couple of days, and we're hearing reports of more and more of an aggressive crackdown. A human rights group in Iran has said that more than 650 people have been killed. Thousands have been injured since these protests began at the beginning of the year. They've been going on for almost 2 weeks now, and you hear stories of bodies being piled up outside hospitals as well. So it's very difficult to actually ascertain what is happening on the ground so long as the Iranian regime and the government continue to try to suppress the information that is being disseminated to the outside world. But at the same time, we know that there is a lot of international scrutiny about what is taking place. The Crown Prince, Reza Pahlavi, who is obviously the son of the former leader that was deposed in 1979, he has been taking to social media encouraging protesters protesters to join in these mass demonstrations. And we know that President Trump is watching the situation very closely. Over the course of the weekend, there was some discussion about whether the U.S. may want to get involved militarily or not. Now, it looks as though in the last 24 hours that he is backing away from that somewhat, opening up the channels to potential diplomacy. The Iranian foreign minister, Arakshi, did reach out to Witkoff over the weekend to restart some of those discussions. But again, you could say that these were discussions that attempted to take place after the Iran-Israel war last summer, did not yield any results. Why would this time be different? Similarly, President Trump has threatened to act so long as the Iranian regime continue to suppress those protesters. So it is a matter of the U.S. having to do something. The question is what exactly?
Some have been quick to suggest perhaps we'll see a collapse of the regime, but this has a long way to play out.
Most certainly. And what you need to understand is Iran isn't a completely homogeneous society. And you have maybe 60% of the population that is Persian, but then you also have a demographics population construct that is constructed from different minorities as well. So there is, what you could say, there is opposition for sure to the government, but it's not necessarily a unified opposition. And herein is one of the dilemmas. What would replace the regime? What would replace the Islamic Republic in case the regime were to fall? The second question is, at this point in time, there are no signs that the IRGC, that the security forces are turning against their leaders. And for the time being, they have been acting out on orders. So this is what we understand. Again, it's difficult to really ascertain what's going on the ground there. But as long as the security forces continue to obey the leaders from above, then it is difficult to see how these protests can actually turn into a full-blown coup, and therefore the revolution and ultimate regime change that many in the West have been calling for. So it's still very early days. But again, keeping track of the mounting death count, the injuries, and of course the very dire situation on the ground just in terms of information dissemination as well.
Jumana Bisachi, Horizons Middle East and Africa anchor, we thank you so much for that. Let's get insights with our next guest, who is one of the most distinguished scholars on Iran. Trita Parsi is Executive Vice President at the Quincy Institute and joins us from Washington. Trita, good to have you with us. What are you making of the narrative coming out of Iran? And now that, there isn't a complete, blackout of information thanks to Elon Musk, how much clarity do we have what's happening on the ground?
So the clampdown on the internet by the government was extremely efficient, including their jamming of Starlink, which then made sure that very little information came out. Now, after they apparently believe that they have managed to clamp down and really reduce the intensity of the protest for the last 2 days, there haven't been much at all, particularly in Tehran. They're now talking about potentially opening it up a little bit. It's been easier to get in touch with folks in Iran. It was next to impossible a couple of days ago. The picture that is emerging is one in which the government has used tremendous amount of force and violence to clamp down. The estimate of the U.S. government is 1,600 dead. But at the same time, it's also an estimate of the U.S. government that hundreds of Basij and police officers have been killed as well. And I think that is suggesting that there are elements of the protesters as well who are using significant violence. I mean, this ratio we've never seen before in Iran. And this is, again, a clear indication the Iranian government did not get deterred whatsoever by Trump's red line. But at the same time, even if they manage to clamp down and the protests die down, it is probably temporary because the underlying factors that is driving people out on the streets and that is causing them to protest have not been addressed and probably cannot be addressed unless there is some sort of sanctions relief offered to the Iranians.
Does it make U.S. intervention likely in the next few days? And how would the U.S. intervene? What will it target?
Well, I think we should be very clear. The intervention is not going to take place as a result of trying to protect the protesters. There may be some spin around that. There may be some spin-off effect in which that will happen. I doubt that, nevertheless. But the plans to attack were coming long before these protests. Israeli Prime Minister Netanyahu visited Trump on December 29th, stayed for a couple of days, and the top of the agenda was that the Israelis wanted the U.S. to attack Iran or to help Israel attack Iran again, because Israel's last war in June of last year was a failure ultimately for the Israelis. So they were itching to restart the fight. The protests began. Trump suddenly shifted his narrative and started talking about protecting the protesters, but the plans were in there already before. And if there are strikes, the strikes are going to be targeting the nuclear facilities, missile facilities, etc., probably going after the top leadership, etc. Whether that helps the protest or not is frankly not the key objective here for the United States.
The thing is, people were quick to point out that the regime will be collapsing. This time is different from the last. How vulnerable really is the Iranian regime right now?
Without a doubt, this looks very different from previous protests. But I think it's also very clear that the regime itself sees this as an existential battle. As a result, have used a tremendous amount of force. We have not seen that Trump's threats of violence have caused defections. On the contrary, it seems to have consolidated the regime. So, for instance, the Iranian army, which is different from the Revolutionary Guards, is non-politicized, have in the past refused to partake in clampdown against protesters. Even when they've been asked to, they refuse to do so. This time around, they themselves came out and said that they are going to be involved in taking out what they call terrorist cells inside the country. I think that suggests that the regime does, not just the IRGC, but the army as a whole, sees the protest as being intertwined with these external threats that the Iranians are perceiving, mindful of the threats coming from Washington and the threats coming from Israel.
What are the chances that we could see a regime that's more hardened? We might see reshuffle at the top, but basically a hardened status quo. What's the likelihood of that happening, and how concerned are you that might happen?
If the regime were to fall, the most likely scenario is not that there would be the son of the former Shah or an element of that kind from the outside that would take over. It would likely be other elements from within the regime that would take over. And that could very well be, and quite likely be, more hardline elements. That is a concern that always has existed within the U.S. government, that not that there is any fuzzy feelings about this current regime, but that what likely will replace it may actually be a hardened version of the same regime.
Iran says it will retaliate if the U.S. were to attack. What form might they take? What leverage does it have?
So the Iranians have said this in the past as well, that they will retaliate, and by and large they didn't. Instead, they did symbolic strikes, made sure that the U.S. had emptied its bases, and then they struck an empty base, essentially. This time around, it seems like that may not be the case, that they actually will strike. They have the capability of striking U.S. bases. Their missiles were very effective in penetrating Israel and America's air defense systems. So this is absolutely not going to be something that will not be a bloody affair. I think there's also a realization on the Iranian side, perhaps not on the American side, that the Iranians probably know they cannot win a war against the United States. However, all they need to do is to make sure that they destroy Trump's presidency before they lose. That's a very different proposition. A couple of weeks of war with intense casualty rates on the American side, even though the Iranians will take far greater hits, will probably be enough to destroy Trump's presidency.
And it could also perhaps target the Straits of Hormuz and cause a lot more damage than the international community really wants.
Certainly, and in the past, the Iranians have had the capability of closing the straits. It would obviously not be able to remain closed. The U.S. would intervene in such a scenario. But we're also seeing that now closing the straits may not be as cumbersome of an effort as it was 20 years ago, because now they can use missiles just like the Houthis did in order to shoot at ships. And even if they don't hit any ships, it doesn't matter. Bottom line is that ships will stop going through the straits to a very large extent, precisely because the risk is too high. The insurance costs would be too high. So even by not actually hitting any ships, they could still cause a significant damage to the oil markets.
We know that Khamenei still holds absolute power, but Iranian politics is pretty divided. Where do the sides stand, and how may that influence what actions are taken by Iran?
Well, the Iranian system is not like some of these other countries, such as Iraq under Saddam or Libya under Gaddafi, or even Venezuela, in which all of the power is centered in the hands of one person at the top. He is undoubtedly the most important and influential person within that system. But power is dispersed throughout the system, which then also makes an effort of just taking out the top leadership and replacing it a little bit more difficult than it would be, for instance, in the case of Venezuela, in which, taking out Maduro or arresting him, kidnapping him, whatever verb you want to use, nevertheless could have caused a complete collapse for the United States to negotiate a deal in which the number two would take over. Such a scenario is much, much more complicated in the Iranian system, in which power is far more dispersed than it was in most of these other systems. So, for instance, taking out Saddam was sufficient for the entire state to collapse.
Trita, some point to the Israel lobby in Washington. How might Israel influence or shape what happens next?
Well, the Israelis are extremely active right now, pushing Trump to take full military action against Iran. On Israeli TV, they've even said that just as Israel bombed Syria after Assad fell, in fact, they said 20 minutes after Assad was on the plane to Russia, the Israelis began bombing everything in Syria that had any military importance, and that they hope that the United States will do the same with Iran after the regime falls, which is a very important thing to note, that this is not about just changing the regime and hoping that Iran has a democracy. This is about taking out Iran's capabilities to challenge Israel's dominance in the region. And that is something that the Israelis will pursue, whether there is a democracy in Iran or whether there is a different variation of this regime.
Trita, before we let you go, what are you focusing on? What do you see happening in the next few days?
Well, I think the most important thing is going to happen within the next 48 hours, and we'll see if Trump finalizes a decision to strike, how that will be, or whether he will actually find an exit out of this. He is, at the end of the day, inclined to do things that are big and bold, but at the same time, he wants to avoid messy situations in which he doesn't have a clear, quick victory. He doesn't have a clear exit plan if it doesn't work out. So it is a tough sell for those who are pushing him to do this, particularly when it seems like the situation in Iran is much, much more messy than I think the U.S. assessment was earlier on.
Trita, great perspective there. Trita Parsi, Executive Vice President at the Quincy Institute. Now, still ahead, we're live from the UBS Greater China Conference in Shanghai. Our exclusive conversation with the bank's CEO, Sergio Ermotti, is coming up. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. UBS CEO Sergio Ermotti says he sees secular trends supporting interest and deal activity in the Chinese market, which are likely to continue in 2026. For more, let's bring in our China-Asia, or rather Chief Asia correspondent, Stephen Angle, who joins us live from the bank's Greater China Conference in Shanghai.
Yeah, that's right, Haslinda. I mean, it was a wide-ranging conversation, exclusive interview with Sergio Ermotti, the UBS Group CEO, here at the UBS Greater China Conference, the 26th annual conference. Yes, we talked about China. Yes, we talked about AI, a lot of different subjects, including those controversial Swiss banking reform proposals, which he says go too far. He says this is a political process right now in Switzerland that should shed some more clarity by the second half of this year. As I said, in this wide-ranging interview, we began by talking about the bank's prospects here on the mainland China.
Last year was a quite important year for China. I think that we saw a huge interest coming back on the Chinese market. Stock performance was great, and we see it today. I mean, we have almost 3,600 participants. You go through across the board from corporates, institutional clients, family offices, and coming from also all over the world. We see also more interest from overseas, which is indicating the momentum of the Chinese market. So I think that we believe this is going to continue. The secular trend supporting China in terms of growth in innovation, in technology, in biotech is here to stay, and investors are realizing that.
What kind of deal flow, though, are you starting to see as we are starting to see China get some momentum? You talked about the stock market, the CSI 300 up about 17% last year, so it's gaining some steam, but also outbound deal flow seems to be growing quite a bit, whether it's investing in factories in Europe or in the global south. It seems like capital is not only coming into China, where foreign interest is obviously looking at that rebound, but also the capital is moving abroad.
Yeah, I mean, look, it's a good mix of businesses, but when you look at, for example, the underweight of international investors to China, almost half, from around 2.5% in 2024 to 1.3% or so in 2025. So this is a significant change on a year-on-year basis, and this is the main driver. We continue to see a lot of activity around IPOs, particularly you saw the record IPO issues last year in Hong Kong, which are probably going to stay with us also in 2026. We see a lot of activity across Asia. Inbound and outbound M&A in Japan is up threefold. So in general, I would say that you will continue to see momentum of Chinese investors investing abroad, but also capital coming into the country.
What's going to be your priority onshore for 2026? Last year you got the full 100% securities license. Yeah. What's going to be the priority?
We are working on all of this. We also last year we also made a capital increase in our local entities, and I think this year we are now planning to launch a Panda bond. So I think that we want to continue to foster our presence in China. We have been in China for mainland China for 35 years. We have been in Hong Kong for 60 years. So this is really part of our core business. I mean, if you think about, we are managing in the region more than $1 trillion of assets, 800 plus in wealth management and 215 in asset management. So we want to continue to reinforce that position, but at the same time, our leading position in the investment bank across the board, and where we are a leader in the region and in China, mainland China particularly, and also in asset management through our very successful joint venture with ICBC.
How would you assess how your businesses in Asia are doing versus other regions, whether it's Europe or?
Well, look, Asia has been growing, very fast in the last years. It's probably the biggest engine of growth in nominal terms. Is accounting for around a quarter to 30% on average in the last 5 years of our profits. So as I mentioned, we manage more than $1 trillion of assets out of the $7 trillion we manage globally. So it's a growing, steady growing business, which when you look at the engine of growth is, GDP growth is definitely going to help. 4.5% in China is quite important, but it is a driver for growth in the entire region. We are selectively gaining some market shares in areas where we want to compete. And last but not least, this monetization, this IPO calendar is very important to our wealth management business, because this is really helping us to drive net new money, net new assets into our wealth management franchise.
Well, speaking of that IPO pipeline in Hong Kong, it's been quite strong. A lot of the new economy companies, but there are also concerns of the new economy companies, whether it's Minimax or others, that profitability, just like the AI companies in the United States and Western markets, that the sustainability is not necessarily, it doesn't have a lot of visibility. But what's your views on whether we're in a bubble and how long that potentially could still last?
I don't know if we are in a bubble or not, but of course, when you see this kind of multiples and performances, you have to ask yourself, is this a repeat of what we saw in maybe in another time?
2001?
Exactly, the TMT bubble and so on and so forth. I would say that in general, first of all, our advice is very clear. Diversification, no concentration of risk around this sector. The technology and is here to stay. But we should not really mix the two issues. From an investor standpoint of view, it's very important to diversify, not to get into a trap of trying to pick up the winner or the loser. But the truth of the matter is that the first wave was probably around the technology sector. Now we're going to see how embracing and implementing AI can help other parts of the economy.
And Ermotti says pretty much the integration with Credit Suisse will be finished by the end of this current first quarter, so by April, and that in Asia it is already pretty much a done deal. So we have more coverage, exclusive coverage from the UBS Greater China Conference here in Shanghai coming up tomorrow with more interviews. Haslinda?
And Steve, I apologize for mangling your title. Steve, of course, our Chief North Asia correspondent. And there's more from the UBS Greater China Conference on our show tomorrow. As Steve said, join us for a conversation with former U.S. diplomat William Klein on the world's growing geopolitical challenges. Plus, we get the outlook for M&A across Asia this year with JP Morgan's Rohit Chatterjee. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.